Welcome back to the channel where we break down the biggest moves, the hidden signals, and the future of XRP that most people are still sleeping on. Today's topic is not just important, it could be one of the defining catalysts for XRP's next major move. The question is simple, but the implications are massive. How will ETFs affect XRP's price? And more importantly, are we looking at a moment that could completely reshape how XRP is valued in the global financial system? Because if you've been paying attention to what happened with Bitcoin after ETF approvals, then you already know this isn't just hype, this is structural change. Right now, XRP sits in a very unique position in the crypto market. Unlike many other digital assets that rely purely on speculation and hype cycles, XRP has always been tied to real-world use cases, particularly in cross-border payments and financial infrastructure. The company behind it, Ripple, has spent years building relationships with banks, payment providers, and financial institutions across the globe. But despite all of that progress, there has always been one major limitation holding XRP back from reaching its full price potential: access for institutional capital. This is where ETFs enter the picture, and this is where things start to get very interesting. An ETF, or exchange-traded fund, acts as a gateway for traditional investors to gain exposure to an asset without needing to directly own it. That means no dealing with crypto exchanges, no worrying about private keys, and no technical barriers that usually prevent large institutions from entering the space. Instead, they can simply buy XRP exposure through regulated markets, just like they would with stocks or commodities. And when that door opens, it doesn't just bring in new money, it brings in a completely different class of money. We're talking about pension funds, hedge funds, asset managers, and institutional players that manage billions, sometimes trillions of dollars. These entities don't typically move fast, but when they move big. And more importantly, they move in a way that creates long-term trends rather than short-term spikes. That's exactly what we witnessed when Bitcoin ETFs started gaining traction. The narrative around Bitcoin shifted almost overnight, from a speculative digital asset to a legitimate investment vehicle recognized by traditional finance. And that shift in perception played a huge role in driving sustained price growth. Now imagine that same transformation happening with XRP. For years, XRP has faced uncertainty due to its legal battle with the U.S. Securities and Exchange Commission, which created hesitation among institutional investors. Even those who saw the potential were reluctant to get involved because of regulatory risk. But as clarity continues to improve and the possibility of an XRP ETF becomes more realistic, that hesitation could quickly turn into demand. Because once XRP is packaged into an ETF structure, it effectively removes one of the biggest barriers that has kept institutional money on the sidelines. And here's the key insight that many people overlook. Markets are driven just as much by perception as they are by fundamentals. The introduction of an ETF doesn't change XRP's technology overnight, but it changes how the asset is viewed. It sends a signal that XRP is now part of the regulated financial ecosystem, which instantly increases confidence among large investors. And when confidence increases, capital follows. That's when you start to see consistent inflows rather than sporadic buying, and that's what can create a sustained upward trend in price. At the same time, it's important to understand that ETFs don't create instant explosions. They create pressure. Continuous, underlying buying pressure that builds over time. Instead of sharp, unsustainable pumps driven by retail hype, you get gradual accumulation that strengthens support levels and reduces the likelihood of extreme crashes. This kind of price action might not look as exciting on a day-to-day basis, but over weeks and months, it can lead to significant gains. And for long-term holders, that's exactly the kind of movement that matters. However, this doesn't mean the journey will be smooth. With increased attention comes increased volatility. Institutional players are highly strategic, and they often take advantage of market emotions to accumulate at lower prices. That means even in a bullish, ETF-driven environment, there will be pullbacks, fake-outs, and moments of uncertainty designed to shake out weaker hands. The difference is that underneath all that noise, there could be a steady flow of capital entering the market, quietly pushing XRP higher over time. So when you ask how ETFs will affect XRP's price, the answer isn't just about a sudden spike. It's about a complete shift in market structure. It's about moving from a retail-driven asset to one that is influenced by institutional capital at a global scale. And if that transition happens, the price impact could be far greater than what most people are currently expecting. Because by the time the majority realizes what's going on, the smart money may have already positioned itself, and the opportunity to enter at lower levels could be gone. Continuing from where we left off, behind ETFs is not just about hype or headlines. It's about how capital actually enters a market and how that changes the entire structure of price behavior over time. When we look at what happened after the ETF momentum around Bitcoin, the most important detail wasn't the short-term volatility, it was the consistency of inflows. Day after day, new capital entered the market through regulated channels, and that created something the crypto market had rarely seen before: predictable institutional demand. This is where things become extremely relevant for XRP, because unlike retail-driven rallies that rise fast and fall even faster, ETF-driven demand behaves differently. It is systematic, it is scheduled, and most importantly, it is forced buying based on fund inflows rather than emotional speculation. If an XRP ETF were approved, every new dollar invested into that fund would require the underlying asset to be purchased in the open market. That means direct, continuous pressure on supply. And when supply meets consistent demand in a relatively fixed liquidity environment, price discovery moves upward, sometimes slowly at first, then faster as momentum builds. Now consider XRP's current market structure. A large portion of its supply is already in circulation, and liquidity is distributed across exchanges, institutions, and long-term holders. That creates a sensitive balance where even moderate increases in demand can create noticeable price movement. Unlike assets with unlimited expansion or weak demand absorption, XRP tends to respond more sharply when large buyers step in. This is exactly why ETF participation could have an amplified effect compared to other more saturated assets. Another key factor is how ETFs change investor psychology. Before ETFs, many institutional investors simply could not justify exposure to crypto assets due to compliance restrictions, custody concerns, or internal risk frameworks. But once a regulated ETF product exists, those barriers begin to disappear. Suddenly, XRP is no longer a gray area asset. It becomes part of a structured investment product that fits within traditional portfolio models. That shift alone can unlock billions in sidelined capital. But there is another layer to this story that most people overlook. ETFs don't just attract long-term investors. They also attract arbitrage activity, hedge positioning, and algorithmic trading strategies. That means liquidity increases, but so does market complexity. As more sophisticated players enter the ecosystem, price movements become more efficient, but also more reactive to macro conditions. In simple terms, XRP would no longer be trading only on crypto sentiment. It would begin reacting to broader financial market flows, just like equities and commodities do. This is where the connection to Ripple becomes even more important, because XRP is not just a standalone speculative token. It is deeply tied to payment infrastructure development, banking partnerships, and global liquidity solutions. If institutional investors begin viewing XRP through the lens of an ETF, they are also indirectly acknowledging the broader utility narrative behind it. That means valuation could start incorporating both speculative demand and functional adoption, which creates a much stronger long-term foundation. At the same time, we cannot ignore the role of regulation in this equation. The involvement of the U.S. Securities and Exchange Commission has historically been one of the biggest overhangs on XRP's market performance. Uncertainty tends to suppress institutional participation, even when underlying fundamentals are strong. But ETF approval would signal a level of regulatory acceptance that removes much of that hesitation. And in financial markets, regulatory clarity often acts as a trigger for rapid capital reallocation. However, even with all these bullish structural factors, the path would not be linear. ETF inflows can accelerate, but they can also slow during risk-off environments. Macroeconomic conditions, interest rates, and global liquidity cycles would still play a major role in determining how aggressively institutions allocate capital into XRP exposure. That means while ETFs create a powerful demand engine, they do not eliminate volatility, they reshape it. And this is where the real opportunity narrative begins to form, because early stages of ETF adoption are often where the biggest inefficiencies exist. Retail participants usually underestimate the speed at which institutional frameworks can scale once approval is granted. What starts as cautious allocation can quickly evolve into aggressive positioning if performance meets expectations. And if XRP enters that phase, the price reaction could extend far beyond what current market sentiment is pricing in. So when we break it down, ETFs are not just a bullish event for XRP. They are a structural gateway. They change who can buy, how they buy, and how consistently demand enters the market. And once those three variables shift together, the entire price discovery mechanism begins to operate under a new set of rules. Now let's go deeper into something most people completely underestimate when discussing ETF impact on XRP: the supply-side mechanics. Because while everyone focuses on how much money will come in, very few actually understand what happens when that money starts chasing a relatively constrained and strategically held supply. This is where things start to get explosive in theory, and very important in understanding long-term price behavior. When we talk about Bitcoin ETFs, what made them so powerful wasn't just demand. It was the way demand collided with a fixed and increasingly increasingly illiquid supply. Long-term holders removed a large portion of Bitcoin from active circulation, while ETFs required constant acquisition from the open market. That imbalance created persistent upward pressure. Now, if we shift that exact logic toward XRP, the structure becomes even more interesting in some ways, because XRP already has a highly distributed market, with a significant portion held by long-term participants and institutions. But here is where the nuance matters. Unlike Bitcoin, XRP's supply dynamics are also influenced by escrow mechanisms and structured releases tied to Ripple. That means the available circulating supply is not only determined by market holders, but also by controlled releases over time. In a scenario where ETF demand enters the market, this controlled supply model could actually amplify price sensitivity. Why? Because new ETF-driven demand does not wait for perfect timing. It buys continuously based on inflows, while supply enters the market on a predefined schedule. Now imagine this situation playing out in real time. ETF inflows increase steadily, institutional demand grows, and every day a portion of supply is absorbed by funds that are required to hold the underlying asset. At the same time, long-term holders, who already believe in XRP's future, are not actively selling at low levels. This creates a tightening liquidity environment where available sell-side pressure becomes increasingly thin, and in markets, when liquidity dries up while demand remains constant or growing, price does not move gradually. It begins to move in sharper and more volatile steps. Another important layer is how market makers respond to this type of environment. When liquidity becomes thinner, spreads widen, and volatility increases. This attracts algorithmic trading systems that exploit inefficiencies, which can create rapid short-term swings even within a broader uptrend. So even if ETF adoption is fundamentally bullish, the actual price chart may look chaotic in the short term. Sharp dips, sudden spikes, and liquidity grabs become more frequent because the market is adjusting to a new type of buyer, one that does not trade emotionally, but allocates mechanically. And then we have to consider the psychological shift in retail behavior. When ETFs enter the picture, retail investors often assume institutional money guarantees stability, but in reality, early ETF phases often bring uncertainty before clarity. As funds accumulate, price may rise slowly at first, causing frustration among retail participants expecting immediate exponential gains. This leads to a common cycle: early disbelief, mid-cycle hesitation, and late-stage FOMO. And historically, by the time retail fully recognizes the trend, a significant portion of the move has already occurred. This is exactly why understanding ETF impact on XRP is not just about price targets, it's about timing of participation. Because once structural demand begins to build, the market stops reacting purely to narratives and starts reacting to flow data. And flow-based markets behave very differently from sentiment-driven markets. In flow-driven environments, even small, consistent inflows can create large, cumulative effects over time. Now bring this back to U.S. Securities and Exchange Commission involvement. Regulatory approval doesn't just allow ETFs to exist, it signals a shift in how the asset is categorized within global financial systems. Once that shift happens, XRP moves from being an alternative digital asset to being considered within regulated asset allocation frameworks. That alone changes how risk models evaluate it, which directly impacts how much capital can be allocated. So what we are really looking at is not just demand entering XRP, it is a restructuring of how demand interacts with supply under a regulated environment. And when those two forces collide, markets tend to reprice faster than most participants expect. Building on everything we've discussed so far, now we need to zoom out and look at history, because markets don't move in isolation, they move in patterns. And when we study ETF-driven cycles in assets like Bitcoin, we start to notice something very important. The biggest moves don't happen on the announcement. They happen during the transition phase when institutional positioning quietly accelerates under the surface. When Bitcoin ETF narratives first started gaining serious traction, most retail investors were focused on price targets, hype cycles, and short-term volatility. But behind the scenes, a different process was unfolding. Institutional desks were building exposure gradually using structured inflows, hedging strategies, and long-term allocation models. That meant price didn't just react, it absorbed liquidity in stages. First hesitation, then accumulation, then expansion. And once enough supply was absorbed, momentum became self-reinforcing. Now, if we apply that same framework to XRP, the structure becomes even more fascinating. Unlike Bitcoin, XRP is not purely a store of value narrative. It is deeply connected to real-world financial infrastructure through Ripple, which already positions it differently in the eyes of institutional analysts. That means ETF demand would not only be evaluated as speculative exposure, it could also be interpreted as indirect exposure to payment settlement technology and cross-border liquidity systems. terms. This dual narrative matters more than most people realize, because when institutional capital evaluates an asset, it doesn't just look at price charts. It looks at utility, regulatory clarity, liquidity depth, and long-term integration potential. If XRP is wrapped into an ETF structure, it essentially passes through multiple layers of institutional filtering. And once that happens, the perception of risk begins to change dramatically. But here's where things get even more interesting. In past ETF cycles, one of the most powerful drivers was not just inflows, it was liquidity compression. As more assets were absorbed into long-term holdings, the available float on exchanges began to shrink. This created conditions where even modest buying pressure had an outsized impact on price. In simpler terms, the market became more sensitive, and sensitive markets move faster. For XRP, this effect could potentially be even more pronounced due to its existing distribution structure. A significant portion of supply is already held by long-term participants, early adopters, and ecosystem stakeholders. That means the freely tradable supply, the portion actually available for active trading, may already be more limited than many assume. Now add ETF demand on top of that, and you begin to see a scenario where available liquidity tightens significantly over time. At the same time, we cannot ignore the role of macro conditions. ETF success is not just about approval, it is about timing within global liquidity cycles. If risk appetite is high, capital flows into new ETFs aggressively. If markets are uncertain or interest rates are restrictive, inflows can be slower and more gradual. That means XRP's ETF impact would not exist in a vacuum. It would be shaped by broader financial conditions, just like equity and bond markets. Another critical lesson from previous ETF cycles is that early stages often feel underwhelming compared to expectations. This is where many retail participants misinterpret the setup. They expect immediate vertical price expansion, but what actually happens is slow absorption of supply. Prices may consolidate or move gradually while institutions accumulate positions quietly. And historically, this phase is where the strongest hands are formed, not during the explosive breakout, but during the quiet buildup before it. This is also where sentiment disconnect becomes most visible. Retail traders often focus on short-term volatility, while institutional players focus on long-term positioning efficiency. That divergence creates emotional friction in the market. People get impatient, narratives get questioned, and conviction is tested. But structurally, nothing changes. The accumulation process continues underneath. Now bring in the regulatory dimension again with U.S. Securities and Exchange Commission. Once an ETF framework is in place, XRP is no longer just reacting to crypto-native catalysts. It becomes part of a regulated investment ecosystem where flows are tracked, measured, and managed through traditional financial systems. That means its price behavior begins to reflect not just crypto sentiment, but also institutional allocation trends. So when we analyze ETF impact from a historical perspective, the conclusion is not just prices go up. The real takeaway is that market structure changes completely. Liquidity becomes more institutionalized, volatility becomes more flow-driven, and long-term trends become more persistent once they establish direction. We bring everything together and answer the core question behind this entire discussion. If XRP ETFs become a reality, what does that actually mean for price in the real world? Not in hype, not in speculation, but in actual market structure and long-term valuation behavior? Let's start with the most important shift. If an ETF is approved for XRP, it fundamentally changes how the asset is accessed by global capital. Instead of requiring exchanges, wallets, and crypto-native infrastructure, XRP exposure becomes available through traditional brokerage accounts. That single change opens the door to an entirely new class of investors who were previously either restricted or unwilling to participate. And when you combine that accessibility with institutional allocation frameworks, the scale of potential inflows becomes significantly larger than retail-driven cycles. We already saw this transformation with Bitcoin, where ETF-driven inflows helped transition it from a speculative asset into a recognized macro-financial instrument. But XRP's situation has its own unique characteristics. Unlike Bitcoin, XRP is closely tied to real-world financial utility through Ripple, which means ETF demand would not only be speculative, it could also be interpreted as indirect exposure to global payment infrastructure. That dual narrative has the potential to attract both growth-focused investors and long-term institutional allocators. Now let's talk about price impact in practical terms. ETF-driven markets do not move in straight lines. Instead, they move in phases. The first phase is accumulation, where inflows are steady but price movement appears relatively muted. The second phase is revaluation, where the market begins to realize that supply is being consistently absorbed. And the third phase is expansion, where momentum accelerates because available liquidity becomes increasingly thin relative to demand. For XRP, this structure could be even more sensitive due to its circulating supply dynamics and long-term holder behavior. If a significant portion of supply remains inactive or held for long-term conviction, then ETF demand would effectively compete for a smaller active float. And when demand consistently exceeds available liquidity, markets do not adjust slowly. They reprice rapidly in search of equilibrium. However, it is extremely important to understand that ETF approval does not guarantee immediate explosive gains. In many cases, the early stages of ETF adoption are psychologically underwhelming. Prices may consolidate, volatility may compress, and sentiment may even turn skeptical as retail participants expect faster results. But historically, this phase is exactly where institutional accumulation is strongest. The real move often begins after this quiet phase ends. Another layer to consider is macroeconomic influence. Even with ETF approval, XRP would still be influenced by global liquidity conditions, interest rates, and risk appetite across financial markets. If macro conditions are favorable, ETF inflows can accelerate aggressively. If conditions are tight, inflows may be slower and more gradual. That means the ETF impact is powerful, but not isolated from the broader financial environment. Regulation also plays a critical role here. The involvement of the U.S. Securities and Exchange Commission is not just about approval, it is about legitimacy. Once XRP is embedded within a regulated ETF structure, it becomes part of the traditional financial system's risk and compliance framework. That shift can significantly increase confidence among institutional investors who were previously hesitant due to uncertainty. So when we step back and look at the full picture, the conclusion is not simply that XRP will go up if ETFs arrive. The real insight is much deeper. ETFs have the potential to transform XRP from a retail-driven, sentiment-sensitive asset into a flow-driven institutional instrument. And in flow-driven markets, price is no longer primarily dictated by hype cycles. It is dictated by sustained capital allocation over time. That is why the ETF narrative is so powerful. It is not just a catalyst, it is a structural upgrade to how XRP interacts with global capital markets. And once that structure is in place, the market may begin to behave in ways that most retail participants are not yet fully prepared for. Financial disclaimer: this video script is for educational and informational purposes only and does not constitute financial, investment, or trading advice. Cryptocurrency markets are highly volatile and risky. Always do your own research and consult a licensed financial advisor before making any investment decisions.